And welcome to today's webinar. I'm not going to say good morning or afternoon because it's just too confusing. Welcome to today's live webinar, End of Financial Year Strategies for Sole Traders and Freelancers, Reduce Tax and Boost Savings. First of all, if everyone can just chuck in the chat, how's everyone feeling today? Are we all looking forward to end of financial year, getting our tax returns, or is it a bit stressful for everyone at this point in time? Doug. Appreciate the enthusiasm, Doug. Good. Moving on. My name is Joel Comerford, and I will be your host for today's session. I'm one of the consultants over here at Lawpath. I'm sure I've probably spoke to some of you before, but I hope to speak to more of you moving forward if you ever need assistance through our portal. Before we dive in, I want to take a moment to let you know what you can expect in today's webinar. The webinar today is designed to not only educate and empower, it's also here to provide an extreme amount of knowledge in regards to sole traders and freelancers like yourselves, with practical, actionable strategies to reduce tax and boost your savings as we head towards the end of financial year. On today's webinar, we will be covering what deductions you may be missing, year-end tax strategies that can save you money, compliance tips, and tools that make end of financial year planning easier. Now, while today's session is primarily about education, it's also an opportunity for us to share how Lawpath's legal accounting and tax services can help you not just survive, but thrive, especially as we move into the end of financial year. At the end of today's webinar, we will have a Q&A, so be sure to stick around and drop your questions in the chat. Throughout the webinar, Tim and myself will do our best to answer questions throughout, but it's always best to just keep until the end towards a Q&A. And for those who are new to this webinar, we will send every episode to our YouTube channel, so you can review all of this. Just type in Lawpath on YouTube, and I will also send out a follow-up email with the PDF slideshow from today's webinar too. Now, today we're joined by a very special guest, Timothy Quinn, our head of tax and accounting here at Lawpath Tax and Advisory. Tim is a chartered accountant with 17 years of experience advising businesses on tax planning, structuring, compliance, and financial strategy. He has worked at the director level, leading tax divisions and helping businesses optimize their tax positions. We're very lucky to have him here today and to share his knowledge with us. I think that's everything at this point in time. So, Tim, if you would like to take it away, please.
Thank you very much for the kind introduction. And you know, far from it to me to step on your feet already. I'm going to overrule you on that. I don't need to wait till the end. If you've got questions, chuck them up as they come. I'm not fussed about that. We'll try and cover off the questions as they arrive. It gives me a good opportunity to stop just reading out from a slide, make it a bit more interesting from you. So please do just drop the questions in the chat, and I'm very, very happy to take them as they come. All right. Joel's given you a bit of a taster. What are we here to talk about today? Today's a bit of a shout out to the sole traders in the room, the ABN operators who've gone out there on a limb. They're not going to be a wage slave anymore, doing it for the man or the woman. They're going to become the man or the woman and set up their own business. It's a brave step. Doesn't always work, as those of you who are sole traders have been doing this for a while know. You're taking a risk, and my hat goes off to you. It's a very rewarding risk when it comes off. So I'm here to make things a little bit easier and talk through, look, what can we do from a tax perspective to make this a little bit more enjoyable. So what are we going to cover off? We're going to talk about tax considerations. Look, they'll be focused at new businesses, but new businesses or those that need to revise or that maybe have gone into things with their head in the sand a little bit about some of the tax considerations. What can we do around year end? What can you claim? What can't you? Are there some tax saving opportunities? Look, how do you consider tax planning? Is it just one of those things that you sort of put your hands over your eyes and wait for your accountant to tell you how much tax you pay, or are you a bit more proactive, or could you be a bit more proactive? Look, Is the sole trader structure the right way for you, or have you become a bit of a big dog and maybe you're thinking about incorporating? These are all things that we can, really cover off today. I'll just make sure that I can actually see the questions as they're coming through. There we go. I've opened up the chat. I can see that now. So anytime, please just go ahead. All right. What are the most important things you guys need to consider from a tax perspective? First of all, tax is not just tax. What do you mean when you think tax? Most people mean one thing. Most people mean income tax. So that's the tax that you pay once a year to the ATO, or if you were an employee before, the tax that your employer used to withhold from you because the ATO doesn't trust you to pay it for yourself. That is what most people think of when they think of tax. But it is just one of many, many, many taxes. And as small business operators yourselves, you know that the taxes keep on coming. As well as income tax, you've got GST, the goods and services tax. For those of you that have been going since before 2000 and 2001, whatever it was now, the GST replaced a whole bunch of state-based taxes. So GST is a little bit simpler than it used to be, still complicated. Payroll tax, that's an absolute pain in the bum. I'm hoping that none of you have payroll tax issues. Payroll tax issues is only when you're paying salaries of more than at least $1 million, depending on what state you're in. So hopefully that's not on your plate yet. We'll talk about some of the specific tax obligations for sole traders. They're a little bit different for every type of entity. So let's really focus on what you are going to be exposed to. And of course, you've got to make sure that you're registered. It's reasonably straightforward when you're a sole trader because you've got your TFN because it's just you individually. And no doubt you're already aware of being required to have an ABN as well. Nice and straightforward for sole traders in terms of your tax registrations. Some other things for you guys to consider. Think about your filing deadlines. Now, as you'll know, they'll come around for most people at least once a quarter. You've got basically 28 days from the end of that quarter to lodge yourself. Good news for me, pat myself on the back, as a registered tax agent, we get a bit longer. So we actually get an extension. Why is that? That's a very good question. I think the ATO trusts us because they know that if we do the wrong thing, we lose our license and we can't operate. So we get a little bit longer, a little bit of leeway to lodge and get your BAS paid. Likewise, when it comes to end of year tax returns, you'll see every year the Sydney Morning Herald and the Daily Mail, all the newspapers will all run the same article around the 31st of October saying, make sure you get your tax in. It's due. It's due. Everyone's tax return is due. If you are a sole trader and you have a registered tax agent, breathe easy. That's not due until the 15th of May. So you get basically 6 months. And the ATO doesn't like you telling this, but actually we can extend that into early June as well. So you've got really a long time to prepare your tax. Don't stress, but do go with a registered tax agent. The reason for being is obvious. Obviously, it's good to get it out of your mind, get focused back on your business, stop worrying about tax, but you don't want that late lodgement penalty. The ATO used to be a bit of a kitten in the last few years and sometimes slap you on the wrist, but often they'd let you off with just a warning. They're getting harsher and harsher. They are going to start slapping late lodgement penalties on you. Even worse, if you've got a tax debt as a result of your return and you're paying it late, there'll be interest charged and you will not be able to claim a deduction for that interest, which is absolutely wild. I don't think there's a good reason for it other than it's public policy that they want people to pay tax on time. So the effective interest rate you'll be paying on that is 15% when you consider that you're losing the tax deduction. So really make sure that you're getting ahead of your tax compliance. What do you have to lodge? Again, if you've got an accountant, let them worry about this. But if you're going it alone, there are a few things that you'll have to lodge for you yourself. It's just an individual tax return. As a sole trader, that's the way it operates. You're not a separate legal entity. Your business is you. So your business income goes straight into your personal tax return. There's a special schedule there for your businesses. So it is treated a little bit differently to ordinary income. But ultimately, it all gets declared on the same tax return, and you pay tax on it just like you pay tax on your interest income or your dividends from your BHP shares or whatever it is you've got. The net profit of your business gets added to your personal tax return. We've just got the standard disclaimer in here. Please make sure you keep records. It doesn't mean every record, every time you go and buy a Mars bar and you've got a $1.30 receipt for anything. But it does mean anything that's important, make sure it's kept. The easiest way to do it is have a digital system, whatever system you use. Take photos of receipts, make sure you keep invoices, just put it all away in a digital shoebox, because these days the old shoebox under the bed of paper receipts is not going to cut it anymore. All right, so we're coming up to the end of financial year. It's coming up brutally quickly. I think we've only got 5 weeks left, closer to 6. What can we do now? What are some steps that you can take in order to make sure you've really made the best of it that you can in the next little short period? You sort of talk to a lot of people. It used to be the case that people didn't like to set up new businesses around now, because it used to be that when you had setup expenses, you weren't able to immediately claim that as a tax deduction. That it sort of got, you could do what was called black hole expenditure. You could claim it over years. Some of the startup expenses just got added to your tax cost base, which is a boring way of saying you weren't getting an immediate deduction. And if you didn't have much income coming through, typically people would just leave it to the start of the new year. The good news is now is that those upfront costs are deductible for your business. And it really doesn't matter how you've paid them. Now, this is not as relevant for you, but perhaps when you're doing your business, you've got even a sole trader ABN business, you've got a business bank account, and then your personal family bank account for whatever else. Don't think that you have to wait until that business bank account is set up. Incur the costs however you incur them, pay them however you pay them. Your accountant will be able to account for those transactions wherever they've been paid for. They just put it in against the director's loan account. It's really straightforward. You get those costs up front, and they are setup costs from ASIC or whoever you're paying them to, but also associated legal and accounting fees in relation to that advice. Get it paid, whoever's paying it, make sure we get the deduction for it. We can claim it up front. If you don't have any income this year to offset that against, no problem. You don't lose the tax deductions, they just get carried forward. So you get to use this year's tax deductions next year if you haven't used them already. Good time to think about your budget. You might think that that's a crazy time to do it around year end, when the year is almost over. But actually, it's the time where everything's front of mind. It's the time when you're looking to FY26, which is about to begin in 6 weeks' time. Now's the time to do your budget for FY26, because it's front of mind for FY25. You should be able to know now, if you've been running for a while, how am I going compared to my budget? It's not, a budget isn't set and forget. You don't just file it away. You should be referring to it, because how you've gone against that budget will determine how you set next year's budget. There's no point budgeting for $1 million profit without changing everything if this year you only made 100,000. I say only made 100,000. What a great problem that would be to have. If this year you had a loss, then next year you're budgeting for a profit where nothing's changing, should be a good reminder to reset your expectations. You got to get that strategy in place. It's got to align to your business objectives. The financial budget can't be different to what you're doing on the ground in your business. It can't be different to what you know on the ground, your research, what your customers are telling you, what the economy is telling you about ability to pay. It's got to be grounded in reality. That sets that base understanding, and it gives you, with your growth strategy for the next year, somewhere to anchor that from as well. It's got to be researched and real. Just had a question come through from Tony. What date does the ATO calculate interest? If you submit it in July 25. So they start charging interest from the date it was due and payable. And they charge that on a daily rate basis. What you can do is that you can apply for interest to be remitted. And it used to be a bit of a joke in that they would always remit the interest. All you had to do was say, "Oh, sorry, I was a bit late. My cat got stuck up a tree," or my fourth grandparent, whatever the reason was. It's not that easy anymore, but when you have a registered tax agent, if there's a legitimate reason for why you're a bit late, even if it was changing tax agents, we can get that interest remitted. So thanks, Tony. Good question. Time also to think about expansion considerations. There's lots you can do about structuring just before year end. If someone was to come to me today with a sole trader business that was making a fortune in profits, and that was going to potentially have a lot of tax to pay, it's not actually too late to change the ownership of that business and get some tax benefit. And certainly for next year, you'll be up and running from day one with with a more tax efficient structure. So it's a time to have a think about it. Is it time to incorporate? Is it time to take your sole trader ABN and become a company? There are tax rollovers, what we call capital gains tax rollovers, to allow small businesses that are sole traders to incorporate without incurring an immediate capital gains tax bill. So it's a good time to have a look at it. Um, in terms of other expansion considerations, you might have been self-funded. You might have been funding your business out of profits or out of savings. Great. Maybe the time to kick up is now. Maybe the time to go and get debt funding or equity funding, so issuing shares or borrowing money. It seems like a crazy idea, but I guess if you're going to have a smaller piece of a bigger pie, maybe that's something you're interested in if you're looking out to get other shareholders or co-founders, depending on the type of business. It's time to think as well about that marketing and the sales plan. So don't have a budget, like I said, that isn't grounded in reality. If you've got high hopes for your business financially, now's the time to think about how to achieve that. It's not going to happen in a vacuum. When we talk about the grants available there, so R&D tax incentives, not a grant technically, it's a tax incentive, but export market as well. A lot of these programs are only available to incorporated entities or perhaps trusts. So for some of them, sole trader ABNs are not going to be eligible. So it's another reason, another maybe reason just to have give your accountant a kick up the behind and say, look, is this the right structure for me? Because it might have been the right structure for you last year or 2 years ago, but maybe it's not anymore. Just before we move on, I've had more questions from Tony. Tony, you're keeping me on my toes today. I love it, keeping it interesting. We've got a question there. Do you have to pay for a formal valuation? It's a tricky one because I do formal business valuations, so I don't want to do myself out of a work out of a job. It's not one of those occasions where you need a formal independent valuation. You should be able to you should be able to personally value your business. The good news is if you're doing what's called a rollover from a sole trader into an incorporated entity where you still own the shares, the actual amount of the value doesn't matter because all it's doing is kicking the CGT tax bill down the road. So if your sole trader business is worth $50,000 or if it was worth $1 million and you use this rollover to get it into a new business entity, it does not matter. So you actually don't really need an independent valuation in that instance. There definitely are instances of restructuring where you do need an independent valuation. So it's one of those occasions where sometimes you do. This is not particularly one of those occasions, but I'd love to help you anyway because it's fun valuing businesses. The instant asset write-off. If you're a political aficionado, you like following the news. Some people are. I'm one of the sad types that does enjoy that sort of thing. You might have heard a little bit about the instant asset write-off. This is one of those things that changes every single year and keeps people like me in a job. It used to be nice and straightforward. It goes up, it goes down. What even worse, these days they wait until 9 months or 10 months into the financial year before telling you what the instant asset write-off is. So it's become a real political hot potato. If you are looking to buy expensive assets in your business and you would like to get the deduction for it now is the time to do it. So up to $20,000, if you can get it purchased and installed and ready for use before the 30th of June, please do so because there's absolutely no surety that it's going to be extended into 2026. I don't have a crystal ball. I can't tell you if they'll extend it. I can tell you they had the opportunity to extend it when they finally extended it to 2025. They had the opportunity to do it into 2026 and they didn't. Now there is obviously a majority government now, but they might need some support in the Senate to get legislation done. Don't rely on it. If you've got that purchase that you need to make anyway, make it now. Let's look in a little bit more detail into deductions. It's probably the meatiest thing. It's probably the most questions we'll get. So I'm sure Tony hopefully will keep us going, or maybe someone else can join the queue and ask some questions. What can you deduct as a sole trader or a freelancer, however you describe yourself? A really nice one for sole traders, which who typically won't have an office, an office rental, but your home office, your internet, phone, electricity, all of this apportionment. You've got an option when it comes to working from home and home office expenses where the ATO will give you a cents per hour rate that you can just apply across the board. You set and forget. It's a really easy deduction to get. It's not particularly beneficial to most small businesses. If you've got 20% of an apartment or 15% of a house, whatever it is, set aside for home office, and you can reliably support that, and if you can track your expenses, you are generally going to be able to get a bigger deduction from tracking your actual expenses. So it's definitely something that I would don't just take your accountant's word that the cents per hour method is easy. It is easier, which might be why they're recommending it. There are often more beneficial ways to do it. Software and subscriptions. How many people out there are paying software subscriptions? I'm one of those terrible people that signs up for a free trial and doesn't cancel in time. At least I've got that fallback of, I can get a tax deduction for it. That Adobe suite that I've paid $400 for without realizing. All of those things, if they're work related, are deductible. They're also immediately deductible. So if you've paid for a year's usage in advance, you can claim that full year's usage now. Your professional fees, of course, all of your Lawpath fees are going to be tax deductible. Of course, all of your other tax agent and legal fees are going to be deductible. Subject to a bit of a carve out about the purpose of legal advice. There are some legal fees that aren't immediately deductible, but you should get advice on that. Most of your legal fees will be. Your equipment and your tools. So this is a common one, of course. If you're running a small business, no doubt you've got yourself a laptop or an iPad or something like that to invoice out of, to run your business through. And you've got stationery, you might have cameras and other hardware things. These are all deductible as well, particularly with the instant asset write-off. These assets under $20,000, you'll get an immediate offset for. You travel, and that's a big carve out that it's not going to be available to most employees. Just traveling from home to the office and the office to home is not deductible. If you're a small business and you're working from home and you're traveling out to clients, there's a difference. So do track your motor vehicle usage, even if it's a motor vehicle that's not owned in the business. If it's just owned by you and you're using it in the business, there's a few methods by which you can get tax deductions for that, either on a cents per kilometer basis or on what we call the logbook method. So there's lots to do with travel, and that can include flights as well. It doesn't have to just include using your car. So if you're flying out for business purposes, do keep track of that. And of course, all of your marketing and advertising. That includes digital services. If you've got Facebook ads and Google ads, and I know that they're very expensive. So, and likewise, you can easily run a report from Google AdWords that's told you just how much you've paid for. Doesn't matter where they're based. If you're selling overseas as well, the entire ad cost is going to be deductible here in Australia. And keep receipts and digital records, of course. Amit's just asked, can I offset instant tax deductions around the 20K market from your sole trader business with a loss with your personal taxable income? You've hit on a very good question. There is a rule, they're called non-commercial losses rules, Amit, where there's a few ways that you can offset business losses against the rest of your income. There's four ways that you can do it, four rules that you can hit. If you don't hit any of those rules, then no, you can't offset business losses against your personal income. If you do hit one of those four rules, you can. So it's going to be personal to you, Amit, and I recommend you talk to your accountant about what those rules are and how they impact you. They relate to how much money you make from your business. If you've had losses over the 3 year or profits for a 3 year period out of 5, if you're particularly capital intensive, if you're using a lot of assets, that's another trip, another way that you can claim it. So you've got some options there, Amit, but do talk to your accountant. Tony's raised a very good question. Can you be exposing yourself to CGT on the sale of your home if you've used a portion for your office? If you are claiming occupancy expenses, which is relating to if you own a house and if you are claiming a portion of the mortgage interest on that, yes, you can expose yourself to a partial CGT bill on your home residence. So yes, Tony, very good call out. It's different for those out there who are renting. Of course, you're not worried about CGT exemptions on the place that you live. But yes, if you do own a home, certainly it's worth considering. That's not going to relate to claiming things like electricity costs, internet, phone, any of those other expenses. It's not going to impact. It's just if you're going to be claiming mortgage interest costs. That's right, Tony. Hamid's just jumped in very quickly. Does the instant asset, all assets up to 20, it's $20,000 per asset. With one caveat, you can't be too sneaky and buy an asset with $19.5 thousand that then has all of these add-ons that make it up to above $20,000. You do have to tread a little bit carefully there. Treat it as just one, as an asset as you use it, but as many assets as you want. Great questions, guys. Please do keep coming in. Deductions you might be missing. So this is when we pick up a sole trader customer client who's been with another accountant for a while or has been doing it themselves. This is typically what we see missing. So those prepayments that I mentioned, if you paid for a years in advance, don't think you need to wait till the next year or apportion it. You can claim the whole thing. And that relates to your insurance, which is typically an annual commitment. Your rent costs, even if it's for the next quarter's rent or however far in advance your landlord requires payment. There's lots of options there that you can claim expenses as and when you're paying them rather than waiting for when you're actually using them. Education and training, look, as long as it's workplace related, go for it. Can be online, can be in person. There are even if you're undertaking quite formal qualifications, at a TAFE or a university, there are ways that you can claim the costs of those courses as long as they do directly relate to your business and will generate you more income from doing that. We can claim them as well. Depreciation, this is if you don't manage to trip the instant asset rules because you've waited till next year, or if an asset's worth $20,000, you can get a portion of that cost deducted to you this year, but we have to spread it over the useful life. So if it's something that we expect will last you 5 years, you'll only get 1/5 of a deduction per year. But of course, try and get the instant asset rules while you can. Client expenses. So yes, I can see Michael's already flagged that there's a question here about client expenses. You do have to be very, very expensive. Very, very expensive. The tax bill will be expensive. You have to be very careful because yes, if you're taking them out to dinner, meal entertainment, which will come with big fringe benefits, tax costs, or non-deductible entertainment costs, I think when we're talking about these sort of client expenses, we're talking about in a meeting having amenities, client amenities, rather than meal entertainment. So certainly not taking them out to the footy as a bit of an incentive to come work with you. No, you'd certainly be needing to consider them. Look at when I say you could be missing these. You might be missing them from the other side. You might think it's deductible. So that's a good call out for Michael. Yeah, in the office, sure, sustenance, but outside the office, do tread very carefully. Different in a co-working space if you're getting catering in or if you're renting a boardroom. But yeah, anytime you're going out to a restaurant or even a cafe, there's going to be certainly an assumption that it's entertainment rather than business related. So thank you, Michael, for calling that out for everyone. Do talk to your accountant, everyone, before you're claiming that sort of expenses. And just a reminder that, of course, the expense has to be related to work. Yeah, no personal costs. It is a very typical problem where, particularly for small business owners that live and breathe their business and that are working in it all the time, it can be hard to separate, which is why we do recommend that you have a business bank account and a business bank card, and you try and stop it from seeping into your personal stuff. Some strategic moves, some tax planning moves that we can do now. Tax planning is one of those interesting things in the accounting profession where a lot of people will try and tell you that it's really complicated or that there are these magic bullets that will solve all of the world's problems. There aren't really. There's a few major levers that you can move, and that we certainly encourage people to look at. It's incredibly valuable in doing so, in trying to do everything you can, but there is no way that you basically go, I have an incredibly profitable business. I'm not keen to spend any money between now and 30 June. I would like to bring my tax bill to zero. It's not going to happen. So let's look at what we can do. The first major lever that we have is our income. We all know that taxable income equals income minus expenses. So of course, we want to push back our income. Now that sounds crazy. Why would I be pushing back income? I want it as soon as possible. If cash flow permits, if you can delay issuing your invoices until July, if you've got milestone working and you can tick off a milestone in early July rather than in late June, you will effectively get 11 and a half months of tax holiday on that income. Anything you're invoicing and billing now, you'll pay tax on in your 2025 tax return. Anything that you can push until early July, so just a week or so, can then be taxed a whole year later. So big incentive to push back invoice, as long as that is commercial reality. Of course, you can't just scribble out the date on the invoice up the top and expect to get away with it. When we say accelerate expenses, bring them forward. If you're going to be paying for these expenses in a couple of weeks anyway, pay them before 30th of June rather than afterwards. So in particular, obviously for that instant asset purposes, try and buy those assets now. But if you've got things like subscriptions which are annual and you've got an opportunity to pay for it now, pay for it now. Pay for those supplies now and bring it forward. There's a particular prepayment that we love as accountants, and I know we've always got accountants on these calls as well. You'll all know the number one strategy is to prepay your superannuation. So if you've got employees on your books, make sure that you prepay their super before the 30th of June, because you'll get the deduction for it then, as opposed to on July 28th when you're paying it anyway. So just like we want to push back income and pay tax on it a year late, we want to bring forward deductions and expenses and get the deduction 12 months earlier. So do prepay your super. It's a particular one for super. I'm sure there's going to be a slide coming up on it, so I'll preempt that anyway. You as a small business owner have a lot of flexibility about superannuation. Unlike most of us wage slaves, you don't have compulsory super as a sole trader. That will mean that you've got a full amount of your concessional cap, which is the cap on tax deductible super. You'll often have the full amount to play with. If you're sitting on a nice cash windfall this year, particularly if you're getting closer to retirement age anyway, you might consider getting a nice juicy tax deduction by putting money into super. So it's one of those things that it's not going to be for everyone, but if you've got the cash and it makes sense for you, there's a big tax strategy in topping up your super, which is the way that we call it. So some year-end habits that will pay off around tax time. Like I said, the separate bank account. It's kind of a no-brainer. Most of the big banks, and particularly Westpac, will offer you very good rates on business banking. It just makes things so much easier. It's going to cut your accounting bills. It's going to cut your headaches. Just have that separate bank account and link it to a Xero. You know, if you're out there using an cloud-based accounting software like Xero or one of the others, and you're linking it to your bank account, your bookkeeping is going to be inordinately easier. It's going to be so much more straightforward. You can lodge your BAS yourselves. I wouldn't recommend it. You should always get an advisor in, but you'll have basically up to the minute visibility on your finances, which is, again, we don't like those surprises. I know no accountant likes giving the surprises, no client likes getting them. If you've got up to the minute business accounting software, you'll be able to see where you're going and how you're tracking. Look, schedule quarterly check-ins. Don't leave, as much as you might not like talking to your accountant, don't just do it once a year after the end of the year. Get an accountant that you're happy to check in regularly, at least once a quarter. Review your BAS together, see how things are going. Is a very strong recommendation. And again, probably the third time I've said it, keep digital records. Don't rely on a shoebox. Don't rely on something that can get mold damage or lost. We're just going to talk through some pitfalls and some mistakes. I've seen them all. I've been doing this for about 18 years now, and I've seen some incredible mistakes. And you'd be surprised, a lot of them are quite innocent, quite inadvertent. Don't think that the ATO doesn't know it. Don't think that the ATO thinks that as soon as you've made a mistake that they're going to throw you in jail. They know what it's like being a small business operator. They understand it. They're quite happy to fix mistakes, but better to not make them in the first place. that mixing of the personal business finance. I sound like a broken record. Please don't do it. I guess thinking that cash jobs don't count. The cash economy is certainly under incredible scrutiny from the ATO. Every year they put out the same report that talks about X billion dollars lost to the cash economy. Pay less, pay cash, all of that thing. They know that it's happening. They've got ways of tracking it. They're getting smarter and smarter. They know that if you're a tradie out there that's reported 30K of income and you're driving a Maserati, they're going to have a look at you. They might also be telling the drug squad to have a look. Who knows? They've got incredible visibility, and if what you're reporting on your tax doesn't match the quality of life that you're exhibiting, expect them to come a knocking. Things like if you're doing the odd side hustle, if you're doing Uber, DoorDash, that sort of thing, that's all taxable. It's all work, even though it feels like pocket money and it doesn't pay that much. You must report it all. Look, again, it's a bit of that mixing of personal business use, private expenses. I'm hoping this customer of mine is not on the webinar, but I won't call them out by name. But we did have in a particular industry someone try and claim $65,000 of clothing, of non-work related clothing or tenuously work related clothing. There is a strong assumption from the ATO that clothing is private. There are some exemptions if you've got a uniform with a logo on it. It's not going to be private. You're not going out on the weekend, hitting up the clubs in your Macca's uniform. That sort of thing is fine. But if you wear a suit to work, like plenty of people do, or have a particular outfit like that, even though you might personally only wear it to work, it is still considered private and is not tax deductible. So very, very careful one to be careful about. Likewise, groceries, you see a lot of that sort of thing pop up again, sometimes inadvertently or personal travel. Ignoring super. So I talked about the good side of super, which is that when you pay it early and when you pay yourself, you can get some tax deduction for it. If you're late or you miss it entirely, you can get in a whole world of trouble. Super is one of those things that the ATO is very, very keen to make sure you pay on time. And again, you will lose deductions and potentially cop some very impressive fines. And that's even regardless of your structure. You might think that as a sole trader, you've left yourself a bit open to attack where a company isn't. I ran a similar session for companies recently, and someone said, well, even companies are becoming more like sole traders now because even company directors can be attacked for not paying super, and it is true. So superannuation is one of those things that you should take incredibly, incredibly seriously. And again, we've talked about those late filing fees. Plenty of people just used to do it late as a matter of course and get away with it. I'm telling you, you can't do that anymore. Michael's answered a wonderful question there from someone about the gym membership for staff. Highly likely to be, in fact, almost certainly going to attract fringe benefits tax. For those of you that haven't had exposure to fringe benefits tax before, good. It's a nightmare tax. It treats every bit of non-cash benefit that you give your employees, non-cash private benefit, it treats it as it should be taxed as 47%. Regardless of your employees' tax rates. So it's definitely a good one to avoid if at all possible. Tony's popped up again. Can tradies claim long work pants if the company requires them to be worn? It depends on the pants. If these are generic long pants that you could wear out anywhere, they're going to be private, even if they're required to have long pants. If they're high vis pants, I'd say that's probably fine to claim. You could probably make the position that you're not going to be wearing your high vis out to the shops. If they're particular pants, if they've got, 23 pockets up the side and a particular belt loop for a trader's belt, yeah. If it is trade specific, forget about the logo. It's still going to be fine. If they're just generic long pants, like you need to have long pants, that's not going to cut the mustard. Hamed has asked, is super not mandatory for sole traders? No, it's not. It's voluntary, so you don't have to. You might want to. So there's plenty of good tax reasons to do it, but there might be good cash reasons not to as a sole trader. And that is, of course, for yourself. If you're a sole trader and you have employees, you do still have to pay them super. Alberto, good to see you again. How do you pay on top-up super? I'd say talk to your accountant because I am your accountant, Alberto. How do we do it? You should book in a session to make it nice and easy. You can use your accounting software to pay super directly these days, or you can do it as simply as working out your fund details and getting their BSB and account numbers and putting in your member number and paying it that way. It's nice and straightforward. The one thing just to be careful of is to know your limit. So the ATO knows that super is very tax efficient and will give you tax incentives to input to super, but it doesn't want to make them unlimited. So it's up to, I believe, $30,000 this year, but don't quote me on it. I'll double check. Um, that limit includes all of your superannuation from employment, but you do still have whatever's left over. If you imagine that you had 15,000 from your employer and there was another 15,000 in your cap, then you could make that payment and just do it before the 30th of June. And that is whether you're an employee or a sole trader, Alberto. So it's nice and straightforward. How to keep things clean. Look, if you're over 75K turnover, you must register for GST. If you're under it, you might want to, depending on your type of your business. You might not want to. Again, talk to your accountant, see what's better for you. Using your logbook or just a digital app, even the ATO has a logbook app these days. There's plenty of ways to do it to track your car expenses. If you've got, like most people, a mixed use, if you're doing it partial for personal, partial for your business, then that's a good way of tracking that. Here's the big trick. Even very successful sole traders in their first year get this bill shock from the ATO. When you're an employee, your employer takes the tax out for you. There's no way around it. So most people get either a nil tax return at the end of the year or a small refund, depending on their deductions. If you're a sole trader and no one's warned you that you've got tax to pay, you might have had a very profitable year. You might have made $200,000 in sales and had 100,000 in expenses. Fantastic. You're sitting on that 100,000. I'll go and spend it. I'll go and put it in the offset account or whatever it is. The risk there is that you've got to set aside 25% of that profit. So you've got to set aside $25,000 because the tax office is going to come knocking for you. So do just try and have a mental idea. Or, of course, Lawpath offers a tax planning service where we will basically look at your business and we'll estimate your tax bills for the next 12 months. And you can rely on that. You can put exactly as much aside as you need to pay for that tax. Keep your documentation. I really am a broken record today. I only say that from a place of love. I'm not saying it because it just to keep harping on about it. Clean records will make a lot of problems go away, even when the ATO issues you an assessment that they disagree with you, even if they come and do audit activity. Having records to support you and showing that you made the effort is going to make your life a whole lot easier. Look, I did already say I knew that this was coming up. The owner's super, as we've gone through. The one thing I did mention is that if you haven't been using that super cap, which a lot of people haven't been fully using for the last 5 years, you can actually top up. And that's subject to you having, I believe, $500,000 or less in super. But that clawback, that ability to go back in time and put money into super now, as if you had at the time, is really fantastic. Particularly if you're a sole trader. I think, like Hamid had mentioned, it's not compulsory. Well, maybe you chose not to use up that because at the time cash was tight and you wanted to reinvest in your business. But now things are going well. Now's the time to put some of that money into super and really get some tax benefit. Non-concessional contributions. Look, if you have used up your tax deductible limit, you can still put more in on top of it. You just won't get a tax deduction for it. So if you're close to retirement anyway, now's a good time to get it into that nice tax effective structure. Now, regardless of what you've heard in the news, superannuation is and will probably always be incredibly tax effective. Just because they sort of round the edges off a little bit, it's still a good place to have your money. Talked about this before. Do prepay that June quarter super. Don't leave it until June the 30th. You don't get the deduction until the super fund gets the money, and they are swamped at year-end time, as you'd imagine. So get it in as early as you can, mid-June if you can, because it's got to be banked. I think we've gone through this before a million times. All I will recommend is get a digital service that backs up, get it in a Google Drive or a Dropbox. It's the nicest, easiest way to do it. You are required to keep records for 5 years, and in 7 years for some circumstances if it relates to employment. So keep it somewhere where you can just leave it and only come back to it. It's what we used to call in audit an SYA file, a save your something file. So we've talked about this at the start, so it's probably a nice way to round it off. Understand your tax obligations. If you don't understand them, make sure your accountant has explained them to you and make sure that they're across them. Make sure you've got a schedule for when things are due, when you'll be paying, and ideally what you're paying. And make sure you get on a payment plan for anything that you haven't paid yet. A lot of people will say, "Oh, I just won't lodge this BAS yet because I don't have the money to pay it." Don't take that approach. Lodge it. Wait for the amount to be payable and due. Get yourself on a payment plan. Your accountant can negotiate this for you, or you can even do it online without even talking to a human being. I think up to about $25,000, you can do it automatically. Um, in some scenarios as well, if you pay off the entire payment plan, you can go back and say, "Can I get the interest back?" And they're quite happy to for successfully paid off payment plans. I'm going to hand back to my good mate, Joel. Joel, you still there, pal?
Certainly am. Thank you so much, Tim. Timothy Quinn, everyone. Timothy Quinn. For those who don't know, Tim's a giant of a man. He's probably about 6'5", Tim, would you say, or 6'4"? Oh, wow. Okay. And what's disturbing is that Tim never played basketball growing up, which is uh, a, an affront to nature. So he's decided to dedicate himself to numbers instead, which is very noble. So everyone, this is the fun part that everyone dreads. This is the discussion around our plans. So I should hope that you've come to Lawpath with a bit of curiosity or um, a need, for example, and hopefully through these communications through legal or accounting, you get a good picture of the kind of knowledge and insight that we have and what we can convey to anyone who is interested in taking that next step for their business. First off, I'll just go over the legal advice plan. Legal advice plan is retailed at $1,668. It's a single payment. You get access for an entire year, unlimited 30-minute consultations with a lawyer every day across anything from commercial, employment, intellectual property, startup law, whatever you need. You also get access to over 500 plus legal documents, and they are all customizable and ready to use whenever you need. The document reviews in regards to the legal advice, drafting, and help with shareholders agreements, contracts, trademarks, anything you can imagine related to business related law, we do it. And it's just essentially, it's really great for new business owners, hiring staff, launching products, or protecting your intellectual property, which seems to be a major issue that I'm getting with a lot of clients these days. Protect your brand. If you have an idea, one of the beautiful things about what I do is when I'm speaking to clients, I get to hear all these amazing ideas that they're having. Now, have these ideas already been created? Yes, but some of them are quite new, some of them are quite unique. But if you can build off something or if you can find a niche within a market and work off it, you want to make sure that you're protecting yourself and you're not stepping on anyone's toes. So we can certainly assist you with that. Adjacent to that is the accounting advice plan, same price, 1,668, same method. You get unlimited access to a senior chartered accountant for an entire year. That's 30-minute calls, Monday to Friday, video call, phone call. You can even have them on a texting basis if you want as well. They're essentially going to advise you on business structuring, tax planning, GST, PAYG, deductions. I assist clients with registering companies every day. It's one of my functions. And a big thing is helping them understand how they can pay themselves as directors through a company, GST advice, payroll, invoicing, bookkeeping, etc. Um, Very much ideal plan for startups and growing businesses, needing guidance without hourly fees, not meaning to step on any of the accountants' attending's toes. And stay ATO compliant while maximizing your business's financial potential. We cover that all with the accounting advice plan as well. Now, next to the accounting advice plan is our tax plan. This is for those of you who wish to just out of sight, out of mind, have someone else do it for you. If you wish to keep it under the one umbrella, which is Lawpath, the accounting and tax are very complementary for one another. So with the tax plan retailed at 2,880 per year, we will assist you with your BAS and tax lodgements, end of financial year statements prepared and reviewed for you, annual tax consultations to review finances and reduce liability. Very much ideal for businesses that want hands-on help managing their compliance with the ATO. Now, another thing we offer is a lot of business structuring conversations within the tax plan as well, which is super helpful. Our legal accounting and tax teams sit among each other. So if you're on the legal advice plan in the accounting, for example, and you just got off the call with the lawyer and you're about to hop on a call with the accountant, the lawyer could just pop his head over and say, hey, by the way, uh, Jane Doe is doing this with their business. I've advised them with this, but obviously please take on this section as well. So you're getting all those fine pillars of support that you need through Lawpath. And if you were ever interested in multiple plans, especially for those new business owners, for example, legal accounting and tax, or just legal and accounting, whatever it may be, we have a bundle and save offer here. So you can put multiple plans together, and then we slap a 40% off discount on top of that as well, which you can see here. Keep in mind, everything is 100% tax deductible, and end of financial year is looming. So if you are interested in kicking off the new financial year with strong intent in mind for future movements for your business, then we would be delighted to support you. That should be everything from my end. Tim, did you want to add anything in there?
No, that's it. You got it all covered, mate.
Beautiful. Now, also, guys, we do have a discount for everyone who has attended today's webinar. It is a tax discount. If I can just get it here in front of me, it's 30% off on the tax plan. So I'll send that out with the email as well. So you can get the discount coupon link there. If you have any residual questions around any of our plans, or if maybe you have some questions but you weren't able to get through it because you were just hyper focused on what Tim was explaining, then feel free to reach out to me via the email afterwards, and I will do my best to make sure that we can respond to those for you. If anyone is interested in learning a little bit more about our plans leading up to the end of financial year, you can just go ahead and chuck yes into the chat there, and I will do my best to reach out to you immediately. But that should be everything for today. Now we can go ahead and jump into the Q&A. Do we have some fresh Q&As or?
A couple came through on the other Q&A function. I did answer one that was a question from I can't remember who asked it, but it was about that's a very good question. I can't remember what the question was either, but it was a nice and easy one to answer. So there was also sort of more of a comment. I think someone sharing a bit of their bad experience of being unable to pay super on time and just how expensive that has been to pay late. So a nice bit of shared experience there to warn the rest of us, I think, about just how painful it can be to pay super late and how expensive that can be. Tony's just asked, do we offer a virtual office service? Yeah, we do. We do have virtual office within the Lawpath offerings, and you can certainly add that to your bundle and get a nice, pretty good discount on that as well, Tony.
Tony, I will reach out to you afterwards with some info on the VO if you wish. Tim, if I may just ask real quick, if someone has, let's say someone hasn't done their business's tax return since 2019 and they've just come by, on average, what is a very tricky question? I apologize if you can't answer it, but if you have a ton of tax returns that you haven't completed, what's the general price that a tax agent's usually going to charge you to have each year completed?
Yeah, it's one of those tricky things because the older it is, the more difficult it is, and particularly for those people that haven't had great records. Look, it's one of those things that I have a price point in mind when I look for it. If a customer comes on board and says, I've got these returns. I typically started at $2,000 per year, but the way that we operate on Lawpath is that we actually have no intention of making any profit from catch-up work. So we do work for our customers coming on board because we want to keep them rolling. The whole Lawpath business model, right, is we want small business owners to self-serve the easy stuff. And we only want to get in and add a little bit of value on the complex bits, the tricky bits. So we ideally want our customers to be up to date and compliant. We don't want to look into the past. We want to look to the future. So we do offer pretty steep discounts to get our clients to that point. So we'll typically offer discounts. We can go a lot lower if there are many, many years involved. It's one of those things where a lot of the work is upfront and one-off anyway, so we can offer multiple year discounts. If you haven't done anything for 5 years, we might be able to get you completely sorted for $5,000, and that includes GST, it includes your annual tax returns. It can include a lot. So we've really got a lot of flexibility. We really want to invest in our new clients and make sure they're up to date.